Jigar Mistry, co-founder Buoyant Capital, who joins us. Hi Jigar, since there's something happened on defense, let's ask you about that. That's the theme that has been red hot. What's your view on defense? Are you in the camp that believes that in the next 10 years it's going to be, India has a big opportunity? Or do you believe all these stocks have already factored in the best? How are you all positioned?
Hi Nigel, good afternoon. Thank you as always for getting me on your show.
Good to have you.
I think forced to choose camp, I'll have to side with the fact that, great opportunity, but we are pricing in more and beyond. Last time I was there, I did mention that we did well in that skirmish, despite a lot of these companies not delivering on time. The opportunity and the runway is large, maybe it's just the start. But essentially, when you do a reverse DCF on a lot of these companies, you are pricing in a lot. Secondly, if you look at the number of shareholders that have increased, in many of these cases, retail has become the largest ownership after the promoter group. And that does not really inspire a lot of confidence, especially when the institutional capital is not backing this up in a big manner. So also the way in which they corrected in the September to February correction in the market, and they've just completely gone back up. So we don't really own a lot in defense.
Can you share some new ideas, Jigar? So much has happened in the markets in the first half of the year, but at the end of it, we've been fairly resilient. Commodities have started declining, crude prices particularly 13% lower last week. Any new trends, any new ideas that have come?
Right. So I think one thing we are taking home, or rather two things I would say, is that, one, eventually the markets will have to transition from a liquidity-driven rally to a more like an earnings-led phase. Right? Because if you look at the FY25 earnings growth, you are still at around 6-7%. And that was also driven by a lot of cyclical considerations. So for the first time, I think since COVID, consensus estimates have started correcting. That used to be the case before COVID in India. For the 5 years, including COVID, you saw a reasonably stable start of the year and end of the year consensus estimates. But for FY26 and FY27, those have started correcting. The one big takeaway, I think, in that transition that we think is happening is, we've discussed the pivot of the governments away from capex into consumption. It started with the central government with, giving 1 lakh crore in terms of lower taxes to medium income housing. States, if you look at what they are, for the lack of a better word, call them freebies. What they're giving in terms of freebies, the announcement exceeds 3.5 lakh crore. What's budgeted is still around 1.5 lakh crore or thereabouts. So you total these two, that's 2.5 lakh crores. Then you start adding in that eighth, pay commission is around the corner. If you total that, that's in excess of 3.5 lakh crores. So combined, you're talking about 6 odd lakh crores, which is like % of GDP, coming away from the sort of state central coffers into the hands of people. And then you will have to start looking at what benefits, discretionary, more or less, staples may not be so much. So I think there is an emerging opportunities that I think a lot of these companies and sectors have not performed well. And I think that is one big thing. We are still evaluating. I won't say we have answers to all of those, but that's an interesting space in terms of what's on offer versus what's priced in.
All right, Jigar, I wanted to ask you about the banking names. Today, the frontline names have taken a bit of a breather. And Karnataka Bank is lower because of its own set of issues. But if I look at the other stocks, you look at RBL Bank, you look at J&K Bank, that one as well is higher. RBL Bank is higher. These are banks that are trading at less than 1 time actually price to book. And my colleague Gaurav actually has neatly put this data together. What is your view? Some of these banks, IndusInd Bank, everyone is throwing in the towel at 650 rupees. Boy, oh boy, now you have 850. The problem in some of these is how is the book looking? What's your view? Would you stick to the large cap names, or do you believe some of these smaller names, they're offering some value out there? And we saw a deal with Yes Bank. There could probably be a deal with IDBI Bank. So there is interest and appetite out there for smaller banks. How would you read it?
Absolutely, Nigel. So I think let's take sort of a bigger call first and then boil it down to names. The bigger call is sort of if you looked at, say, a era before 2015, evergreening was abound. After 2015 until I would say 2018, 2019, you had sort of the NPLs come through. And since then, I think, you've shafted the wheat away from the rust. So essentially, you now have a situation where there are two large business models. One that allow you to report ROAs in excess of 2%, which are all these big boys. And then people are aspiring to be around 1% ROA. And there you have a lot of these emerging companies. Some of the names you did mention do report elevated ROAs, but are trading at a lower valuation. That's entirely sort of stock pickers market there. One big part that we are talking about is while we spoke about central and state capex taking a back foot, corporate capex for the first time has crossed the central capex of 11 lakh crores or thereabouts. And now you are looking at net debt issuances from the corporates, which is after a decade, if memory serves, the companies are borrowing to invest rather than repaying debt. So I would, if I sort of had that opportunity, I would much rather focus on corporate banks rather than retail banking incrementally, because I think that's where the money would flow. Obviously, we can't discuss stocks, but I think in terms of names, we would be banking on a lot more corporate lenders and retail lenders incrementally.
Anything in this entire oil marketing companies? We've seen the decline in crude prices. Is there an opportunity in the oil and gas space?
I think yes. Essentially, you will have a situation where we are not budgeting for an elevated level of crude prices as we go. There will be skirmishes which will lead to these spikes, but eventually we are looking at it being in the 60-65 handle. So net, you will sort of model those recurring margins for many of these businesses. We do own one of them in the oil marketing space, but I think beyond the point, this still state-owned, so you can't build a very large exposure. So it's a middling level exposure for us as well, but neither here nor there sort of.
Do you own any two-wheelers in your portfolio?
No, we think they are, representing a very large optionality in terms of who gets to win the EV game. And, as far as PEs are concerned, it's a good spray and pray approach for them. It's like spread around $1 billion to a lot of players. And then, one of them becomes a winner and then you take it home. But when you're investing from a public investing space, those optionality become a very large part. And although, as I said, discretionary does present an opportunity, we think two-wheelers are more or less sort of pricing that in. So we don't have a large exposure. We don't have any sort of exposure, so to speak.
Okay, all right, Jigar, good to hear your thoughts. Thanks a lot for joining in and filling us in with all of those details. By the way, look at the bottom.